All right, ladies and gentlemen, we are all set. Our third panel discussion for the day. Topic, as I mentioned, managing liquidity, the dynamic of pledging and repledging securities. Please join me as I welcome the moderator for this session, Shri, Kamlesh, Chandra, whole-time member, Securities and Exchange Board of India. Let's welcome him with a round of applause. A very good afternoon to you, sir. Pleasure having you here with us. Please join me as I invite on stage our speaker for the session, Mr. Sundararaman Ramamurthy, MD and CEO, BSE Ltd. We have Mr. Nithin Kamath, founder and CEO, Zerodha. And we have Mr. Jain, co-founder and COO, Groww. A huge round of applause once again to our panelists for joining us today and gracing this occasion with your kind presence. Looking forward for the session. Sir, over to you. Thank you.
Thank you very much. A great opportunity to be here amongst some of the thought leaders of the industry. We are talking about Global Fintech Festival. And when we talk about Global Fintech, you know, they are the kind of people who are here who have shown what it makes to be a successful entrepreneur. We have heard Prime Minister in the morning. Ladies and gentlemen, it was such a wonderful talk which was given by him, how Government of India has enabled technology to create solutions where we have integrated development that everybody, whether he is on a street vendor, whether he is on a village, everybody is participating in the development through the revolution in Fintech. We heard Chairperson yesterday that how in SEBI we are using technology to ease compliance, to innovate and provide solution to the market and investors. What topic we have, and there is a specific reason why this topic has been selected, and we will see how this, why this topic is so relevant to drive a message so far as fintech industry is concerned, so far as technology is concerned, how we can use technology to provide solution. And when we talk about that, we know businesses have used technology to provide solution, to build businesses, to give protection to investors. We have seen stock exchange. I mean, NSE is probably one of the biggest fintech we have. And we have Sundar, who has worked with NSE to make it grow. So it's not only in private sector that we have used technology. In SEBI too, we have been using technology to provide solutions to make sure that investor interest is protected without compromising on business development. So this is one area where we will see how pledging and repledging is one kind of a case study where we have ticked all boxes. And when I say when we have ticked all boxes, there are 3 boxes to be ticked so far as SEBI Act is concerned. We all know it. They are investor protection, development of market, regulation of market. Very often people say that when you tick one box, the other box get adversely impacted. For example, if we bring compliance for investor protection, it results in increased burden on businesses. But it doesn't happen always. There are ways, there are solutions where you can tick all 3 boxes together. So if I have to draw a Venn diagram, I mean, most of you would be aware of Venn diagram. You know, one circle representing investor education, one circle representing market development, and one circle representing regulation. There would be common intersection area. Now, that is what we at SEBI try to focus on, that how can we increase the size of this common intersection. And what I am going to cover today, what we are covering today, pledging and repledging, is one solution which has, you can say, has protected investor interest, has developed market, and has also been a good regulatory exercise. And so let me start with Sundarji. You have been with NSE earlier, now with BSE, and stock exchange is a first level regulator. So from regulatory perspective, what do you think, what was the problem before which this particular solution has tried to fix. So from regulatory perspective, what is the advantage pledging and repledging has brought on the table?
Thank you, sir. First of all, thanks to the organizers for having me in this panel, and thanks to all of you for being present and listening to us. To understand the importance of what we are talking today, we need to see what was in existence and why this is a betterment. When an anonymous order book, order matching concept was brought into India, what happened was in the exchanges, anybody and everybody who trades is actually taking an unknown credit risk. Why we say that? Because he does not know the counterparty. So whether the counterparty is black, white, red, yellow, he doesn't know. Then how he can be clear that his settlement can happen? So that credit risk, through a mechanism of credit upgradation, through novation, got converted into a market risk. Market risk can be managed through margins. And if you were to ask all people who trade to put upfront margin, because that's the route which India chose, and you say if everything has to be in cash, then what happens? There will be no liquidity. Why? Many of the people have converted their cash into other assets. Some people have converted into fixed deposits. Some people have converted them into marketable securities. So it was decided at some point of time regulatorily, people will be permitted to deposit securities as collateral for their margin utilization. How it used to work? People used to transfer their shares to the trading member. The trading member will transfer it to the clearing member. Then what happens? The clearing member will pledge it to the clearing corporation, who is going to provide the settlement guarantee. When these transfers happen, there is a loophole created. Every problem has a solution. Every solution brings a new paradigm of a problem. What was a new paradigm of a problem? The trading member has the full potential to use it whichever way he wants. Same way the clearing member could use. I'm not saying everybody was using, but there was one case which did it. So then what happens to the investor? The investor gave the security thinking it will be used for the purpose of his requirement of trading. But if the trading member decided to sell it off or take the margin benefit of it and give it to some other client, then how do we protect him? When an incident happened, it also highlighted this risk. So what has now been accomplished, which is probably one of the unique things which India has been able to generate in the capital market. The client does not part with his shares. He creates a lien called pledge. And then the trading member repledges it. The clearing member repledges it to the clearing corporation. When the pledges only is in place everywhere, and only to the extent of the utilization of the margin by the client it is used, otherwise it's remaining safe. And no broker is permitted to take, other than through this pledge mechanism, the securities from the clients. So this plugs a very big loophole which was in existence. What is the regulatory requirement? Every act has its birth with its preamble. The preamble of our regulatory act is to protect the interests of investors. Clearly, that is what this pledge and repledge has helped the marketplace to accomplish. I hope I answered.
Thank you, Sundarji. Probably it's a time to move from suited, booted to senior citizens to young, successful, casually dressed entrepreneur, right? I'm sure, the house full and people standing, they have come to listen to these two gentlemen, right? So, Nithin, how do you see as a measure to protect investor interest, and what are the safeguards that have been built for this purpose?
Firstly, thanks for inviting me. Safeguards, Sundar already kind of highlighted all the safeguards that are there. But as an investor, as a trader, my stock doesn't leave my demat account. And this was brought in around 2020. Before 2020, you could when you pledged the stock moved from your account to our account. Just to give you an example, in 2019, I had met Mindtree's CEO, and he came to me and asked, Nithin, you are one of the biggest customers, one of the biggest shareholders of Mindtree, and I was surprised, as in, how are we the biggest shareholder? And then I realized that it was essentially the customers of Mindtree, and the shareholders of Mindtree who had pledged the shares to us. So the shares was transferred from customer's account to our demat account. So on their books, we were showing as a shareholder. That itself is a mega risk, right? And we've ensured that the customer is well protected in that sense, that everything stays in his own demat account. And also there are added responsibilities on the broker, like corporate action when it happens, what happens to the share. Now, typically if the shares were with the broker, he'll have to apply the corporate action and then credit the shares to the customer account. But when the pledge lies, the corporate action happens on the pledged shares. So everything is in the customer demat account. So that way, it's been a blessing for brokers like us to offer the pledge repledge mechanism in us.
Thank you, Nithin. Now, Harsh, I mean, although Nithin just mentioned broker's perspective also at the end, maybe you would like to say whether this has also been helping you people in your business, and if yes, in what way?
Thanks, sir. Thank you, everyone. So while I'm following it, but we launched pledging very recently. It's been a few months, but as a facility, it is helping people to be able to pledge, get a margin. Now with this new regulations, they can keep the holdings on their name. So as a broker, it does help us. Like one of the things that they mentioned, corporate actions used to be a really tedious job because you hold the stocks while there is a corporate action. Now the investor holds it, owns it, so all the corporate actions directly get attributed to the holder. So that's been a great change. Also, the whole mechanism, the way it is built, that customer is able to, or investor is able to pledge it, and the same can then be repledged within minutes through an OTP mechanism, has been a really useful mechanism because the liquidity for a broker gets released. Otherwise, if you are holding the shares and you're pledging, your liquidity goes out, you're providing the liquidity to the investor. But now if you're able to repledge it, your liquidity comes back. So between these mechanisms, I think the whole system has become way more efficient and transparent.
Right. Thank you, Harsh. So basically, if we summarize, what has been discussed so far, we will see that two things which have happened. First of all, the message is, Sundar spoke about some misuse which was taking place, some cases which happened where investors suffered a huge loss because of misuse of security by the trading member. Now, from a regulator perspective, what do we do? Do we go after each of the violator to do enforcement? That is surely one way to address these losses to investors. But the better way to address this is use technology and build a system so that there is no opportunity to misuse. So that is one message, that technology can be used to prevent wrong activity. Second message, which I addressed in the beginning, all three boxes have been ticked. So this is one area which is an example to demonstrate that there are ways using technology you can tick all three boxes. So Sundar, coming back again to you, do you feel that trading volumes, we know trading volumes have been increasing quite a lot in India. So do you think that this particular step has also contributed to increase in trading volume?
Trading volumes do increase because of multiple factors. So I will use a different metric to measure how successful this has been. As a percentage, securities deposited as collateral has almost doubled from what we saw in 2020 to what we are seeing now. So clearly, therefore, the safeguard brought in by this regulatory change has benefited a lot of people, and also in increasing the liquidity in the market is my view.
Right. So you feel that, with increase in liquidity, it is something which is beneficial to the market.
Yes.
Right. So Nithin, do you see any risk in this?
Yeah, I mean, unfortunately there is, because with us, 2020, we used to have 1,500 crore rupees of stocks as collateral. We have 20,000, 25,000 crores worth of stocks. So what it means is we have to continuously monitor, thankfully from 2020 onwards, we haven't had a downturn in the markets where, where someone is using the collateral and loses money on the stocks and also on the F&O position he takes. But that's a big risk. The big risk is if tomorrow, if the collateral, when I say collateral, the stock price drops, and in turn he has futures positions, and we have to square off the positions. That's a big risk. And also there's a concentration risk, as in if too many people have pledged the same stock, then if a broker is pushed, he has to square off, and that can potentially cause impact on the market as well. So yeah, so these are two potential risks. And to Sundar's point, 10% of the volumes, trading volumes, comes from the collateral customers, as in only 10% comes. So trading volumes have gone up, but it's not significantly because of only collateral.
Harsh, your views on risk in this particular initiative, and how do we address it?
Sure. So, there is a risk in the mechanism itself, inherent risk. I think we spoke about it. Like it's a leverage risk, because people are, you already own a stock, now you don't sell the stock, but then you get a margin and a money out of it, and then you reinvest in the market. So there's a leverage risk which is inherently there, and then the liquidity of the stocks, everything is there. But with the mechanism per se, sir, mechanism looks pretty solid, frankly, because you have the holdings and it is in the control, which is not distributed across the brokers. So there's definitely more transparency and more security when it comes to holding the stocks and pledging. There is always the risk that the speed at which this gets pledged, repledged, or even if you want to sell, then unpledged. I think that speed with technology we continue improving, and once that becomes almost real time, then even the sudden movements risk also goes away from the system.
Right. Thank you. So now, as we say that proof of pudding is in eating, so we need to find out whether it has really reduced investor grievance or complaints so far as misuse of security is concerned. We know there are still investor grievance, right? We have a score 2.0, which is working very well. Whatever complaints are coming, we are trying to address them quickly. So, disclaimer, there is investor grievance. But so far as this particular item like misuse of my security by trading member or sometime clearing corporation. Have you seen decline in that area, less number of complaints or no complaint? What is your experience?
So very nicely you have asked put the question, sir. Like investor grievances will continue, but in this specific area about a misuse of collateral by the trading member, certainly there has been a significant drop. There could be other complaints that I tried to pledge and they did not happen in time. Those type of issues will be there and will get ironed out, as Harsh said, when things become more automated online, when things are different. But specific complaint that I am finding misuse by my member is certainly reducing. It's not there now.
So I think that's a very important message that this particular initiative has been successful. But which all countries have this kind of system in place? Nithin, would you have some kind of international perspective on this?
No, as in, no, when I say no, I mean no other country comes even close to what we have to offer. Because in most of the cases, most of the countries, most of the developed markets, the security, as in, in a sense, the security is with the broker. And broker, in turn, marks it as a ledger entry. So the concept of demat account itself is a little gray as such. As in, of course, you have custodian for bigger customers, but most of the retail customers don't really get custodial services. So, I think we are by far the best and the biggest market around the world to offer this.
Thank you. That's a very important point. You can be proud of that. India is like a market leader so far this particular area is concerned. So Harsh, what's your view on this? That do you have some kind of input to give how other countries are doing it for protecting securities of the client? Do you have any idea what system do they have in place? And maybe so far as India is concerned, how do you see the future of this initiative?
So most of the countries, I think a lot of the countries react post any problem, and they do build systems to check if the wrong has happened and then how to penalize on it. I think we are one of the very few countries who put the protection, the check, and the process itself. I think there's a lot more role played by the system, the regulators in general for a country like India than it has been in the developing countries. And it's really been good in that sense. From future, I think there are a lot of things that are happening. There are a lot of things where the transactions, the stocks, underlying collaterals, the volatility, the liquidity, and a lot of intelligence is getting built, which can be used, which will be used over time. From the pledge per se, I think this will keep on evolving as people use it more. I think recently we, as an exchange, reduced the number of shares also from the total list to now, which are the pledgeable list. And this keeps on happening. I think it can keep on happening with more technology use. It can be more continuous, and the risk can still be reduced in the system.
Yeah, thank you very much. Now, friend, I am not going to let these people go away. I know, they are the role model for Indian youth, right? So when 25 years back, 30 years back, they used to be, we are at the, starting technological revolution in India. There were opportunities which were created. How stock market was at that point of time. You see the BSE iconic building and how trading used to take place in that bottom room. You must have seen in that movie Big Bull. It has completely changed. Nobody would have imagined at that point of time that 25 years later, 30 years later, the stock market would be in this situation. But there were some people who saw that this is going to happen. They made use of technology, they created startup, and they are successful entrepreneur today. Same thing is, we are now at the verge of completely new technology, which is going to again change the way capital market is working, the way financial sector is working. But we don't know what it will be 10 years later, 15 years later, but those who are visionary, they have an idea what it would be. And I'm sure that we do have three visionaries here who could visualize 25 years back, 30 years back. So let us ask from them that what do they see as a future in technology and how it will change capital market. Because we sure there are many young, people out there in the audiences who would like to catch those ideas and work on them. Now I will start on the reverse direction. And my only request is, I know you will have some idea in your mind. As an entrepreneur, you will like to keep that idea within yourself. But as a role model for Indian youth, I request you to kindly share what you think. So I start with Harsh.
Yeah, it's very difficult when you're so much into the operations on a daily basis. It's very difficult to step out and think 10 years. While it may sound contrary, sir, that as an entrepreneur, we do have dreams like what we want to build. But just stepping out, if I think, a lot more, still we have seen in the last few years the level of participation which has gone in the capital market, whether it's about mutual funds, SIP, or it's buying stocks. Still, I see a lot more to happen on that side. And both from an education point of view or from an access point of view, there will be a lot of innovations which will be done. I think both these things work when the markets are going good. And in the parallel, the system which is building more trust, more transparency, more stability in the system, which is going to build this inroads to maybe next 100, 200, 300 million people and let them come on the system.
Yeah, Nithin?
Yeah. I mean, we've been big beneficiaries of the market expanding. So I hope the market expands and everyone has got an opportunity to come build something else. But I seriously think the advisory ecosystem in India is not looked after. And thankfully, SEBI has come with a consultation paper now of getting more advisors in. So there are 1,000 advisors in a country of, I mean, even if you think 10 crore Indians who have a trading account, it's very, very, very small. So I think the advisory ecosystem, and especially with the account aggregator now coming into play, and all the financial vehicles are kind of integrated into the account aggregator. So like your UPI, you could use account aggregator to build a financial profile of a person and then be able to advise. So I have a feeling there can be many more advisors. I don't think there'll be any more brokers because, I mean, I can't really think what else will a broker do differently. As in, pricing is really already at the bottom. And technology-wise, the order screen, the et cetera, it'll probably be small increments. But the delta you can create by building an advisory network is potentially huge.
Yeah, thank you. About that advisory network, I can brief the audiences. We are really aware of this fact that the number of investment advisors in India is much, much less, while we have unregulated activity in the form of unregistered influencers going on, which is really, you can say that they are misguiding investors and people are losing money, and a lot of complaints we are getting because of that. So we have created, we have a policy framework in our mind. That policy framework, first of all, we have issued a consultation paper, and we are going to take up in the next board meeting. We have already received thousands of responses on that consultation paper. We will consider that and take it to the board meeting. The idea is that we reduce the entry barriers. We address the concerns of investment advisors as research analysts. We provide clarification to them, whatever are the gray areas, so that they know what is to be done. So once we have this system in place, and then we work with, once again, technological platform, where these unregistered people go and give advice. And we have had very successful engagement with those technology providers where we tell them that these are the people who are giving unregistered advice and they immediately take it down. I can tell you more than 15,000 content sites have been taken down by them in last 3 months, after we have referred to them. We are going one step beyond. We are asking them to create a system so that they identify themselves. Of course, we will also report, but they should also be proactive. So all this work is going on, and with investor education, we do hope that what Nithin addressed, this will create a lot of opportunity for investment advisors in future. Now, to you, Sundar, what do you see?
Sure, sir. Let me take the specific area of collateral pledge and repledge first. When we talk of a technological journey, there will be always some low-hanging, immediate, near-term things. I feel this will become API-fied. What I mean is APIs will be available so that the operational risk which is carried in the system today will go away. Maybe the systems will become intelligent and they will be able to see if somebody has pledged something and he has also traded. It can mark a EPI of that so that settlement risk comes down. These small developments could be there, the low-hanging fruits. Not necessarily visions look plausible and possible when we voice it out. So probably the next level of what I'm going to tell could be one of them. Today we are all talking about AI and ML emerging. At some point of time, I clearly feel that the risk what Nithin voiced out, if somebody is, say, let's assume, pledging, say, X security as a collateral, has significant position in the underlying for that security and also in the derivatives, a movement in that security is going to be a significant risk. Does it tick all the tick boxes now? Yes. But is it creating a residual risk in the system? Yes. Maybe systems will develop. It will alert the intermediaries and the clearing, all intermediaries, market intermediaries, including brokers. It will have a trend analysis, it will have a pattern analysis, it will have a sort of a time spectrum analysis to see this security has a probability to go to this level. If it happens, this portfolio of this man could be a problem, ask him not to trade. That way the settlement risk could get much more contained. It may look like more like a story at this point of time, but I don't think it's not very far away from reality.
Thank you so much. And as I see, we have 4 minutes left, ladies and gentlemen. Probably time for some questions. Anybody who has any question? Okay, but then I should have finished. I should have taken 4 minutes then. Right. Thank you. Yeah. Yeah, we can take one question, please. Yes, here. First round table.
Hello. Yeah, good afternoon, panel. My question to Nithin sir and Harsh sir, to both of you. Like initially there was the service brokers. Then the competition came when the discount brokers came in, and there is no advice, only the broking part. Now the advisory will be a big thing. Both, I think, Zerodha or Groww, everyone have to step in and they have to provide the advice or anything, I don't know. So how the cost effective it will be? With the same price, if you're providing the advice, then I think there will be big play with the cost. So how, what would be the strategy in that?
I mean, see, the thing is, firstly, full service broker and discount broker, I mean, this discount broker term was introduced by us, so it was not really discount, because we called ourselves discount broker because we are offering it a deep discount to other brokers brokering. But the issue with the traditional advisory model with the broker is there's a conflict of interest, right? If an advisor charges a brokerage and is giving advice for free, he's got an inherent conflict of interest. That is, he's going to push a certain advice to get you to transact. And I don't think that's a model here. Here the model is separate. The advisors work on their own. We as brokers are separate. And that's where the opportunity also lies, as in it lies in building many small networks of sorts, So in terms of pricing, that's a challenge, right? Because in India, people pay for everything but advice, But that has to evolve over time, I guess. I mean, one of the requests we had with SEBI, we had made representation some time back, was if we could collect the advisory fees from the AUM, as in from the assets that the customer holds, versus asking for a customer. Every time, because every month you have to collect the advisory fees. If you go to collect the advisory fees every month, and you have underperformed the market, for example, how do you justify the advisory fees? So I mean, these are some of the issues. So.
Yeah, definitely, and I think there will be cost for it. And if there's a good advice, there will be cost, and people will pay for it. I'm seeing the trend changing where, I mean, I think the country is pretty much getting ready for paying for the good service. And advisory being a good service traditionally has come in different forms and factor as a free advice. People think it's an advice, but it's like either incidental or it's more motivated with the different means. But if people see transparently that, hey, this is the quality of service and I'm asked to pay, they will pay. So yes, there will be cost for it because it's really, it's expensive.
Thank you so much. So still, there is no red thing on the time clock. We finish in time. Thank you.